Welcome. Today, we're unpacking how employee ownership stacks up against traditional benefits and what leaders need to know. Over the next slides, we'll compare mechanics, costs, behavioral effects, and practical trade-offs so you can see when ownership creates long-term value versus when conventional pay and perks deliver immediate security. Here's our roadmap. First, we'll deconstruct how ESOPs actually work, then run a comparative analysis across 5 practical criteria. Next, we'll surface hidden risks you should watch for. And finally, we'll end with a short decision checklist so you have an actionable framework to use after this session. At its core, an ESOP is a qualified ERISA plan that can borrow to buy company shares and then repay that loan with pre-tax contributions. The trust holds stock, allocates shares to individual accounts over time, and effectively converts company performance into employee wealth without a payroll deduction, creating a link between business success and personal retirement value. A few tax features power the ESOP engine. Sellers may defer capital gains, corporate contributions to the ESOP are deductible, and S-Corp ESOPs can avoid federal tax on certain earnings. Those advantages combine into a self-funding cycle that lets companies reinvest and grow ownership value, a capability traditional benefits generally lack. When employees stay long-term, ESOP participants often accumulate significantly larger retirement balances tied to company stock growth, sometimes 2 to 2.5 times larger than peers. That alignment turns profitable companies into personal wealth engines for tenured staff, while 401k-only firms typically deliver steadier but capped market returns. Traditional employee benefits focus on core protections: salary, a 401k match, medical and dental, life insurance, and paid time off. Those elements provide immediate liquidity, portability, and predictability, but they usually lack equity upside and tend to rise as fixed costs, regardless of company performance. One limitation of conventional benefit packages is transactional loyalty. Employees work, get a paycheck, and repeat, and many will leave for modest pay increases. In that model, the story ends at the paycheck edge. There's no long-term ownership to anchor commitment or reward someone for helping the company grow over years. From a financial flow perspective, ESOPs are typically funded pre-tax through company contributions into an ESOP trust, which creates employee accounts while remaining cost-neutral after tax benefits. Traditional benefits, by contrast, are funded after expenses and recur annually, exposing employers to escalating costs like healthcare inflation without the same tax offsets. The long-term wealth case is clear. ESOP accounts rise with firm valuation, meaning employees can get a second payday at exit or liquidity events, aligning personal outcomes with company success. Traditional plans deliver a fixed match or bonus and therefore cap wealth creation regardless of how well the company performs over time. ESOPs bring extra complexity and oversight compared with standard benefits administration. Beyond compliance for any plan, ESOPs require trustees, annual independent valuations, repurchase obligation planning, and potential Department of Labor scrutiny, plus education of the board on fiduciary duty, all necessary to protect participants and the company. Ownership changes behavior. Studies show significant reductions in turnover and measurable productivity gains when workers feel like owners. Lower staff churn and a modest lift in efficiency help align daily decisions with long-term goals, producing performance metrics that simple profit sharing or cafeteria perks rarely match. Timing matters. ESOP value generally unlocks on specific events such as retirement, termination, or diversification milestones, so access is delayed but potentially larger. Traditional options prioritize immediate liquidity through 401k loans, bonuses, and cashable benefits, offering short-term flexibility at the expense of long-term upside. A core risk of ESOPs is concentration risk, retirement outcomes tied to the fortunes of a single firm. That exposure can magnify downside if the business stalls. Traditional diversified portfolios spread risk across many assets, offering steadier growth and lower single-entity vulnerability compared to a concentrated ESOP footprint. Repurchase obligations are a practical cash flow challenge. As participants age or retire, the company must buy back shares with cash, creating an increasing liability. Without proactive planning, this buyback pressure can squeeze operating capital, force use of credit lines, and reduce financial flexibility for growth investments. Think of ownership as an additive element in the compensation equation. ESOPs layer equity on top of base pay and benefits, increasing total reward value rather than replacing existing pay. In practice, this means talent budgets usually remain intact. Ownership provides an extra layer of value, not a simple trade-off. For ESOPs to work culturally and operationally, you need three prerequisites: honest board buy-in to a shared ownership philosophy, transparent financial sharing so employees can see performance metrics, and ongoing monthly education to build financial literacy and engagement. Without those, ownership risks becoming an empty slogan. Strategic sequencing helps balance liquidity, growth, and motivation. Keep a 401k match for immediate cash flow and security in year 1. Introduce an ESOP in year 2 to add long-term upside and ownership, and layer profit sharing later for near-term rewards. This staged approach smooths cash impact while advancing engagement objectives. Use a simple scorecard across goals like wealth creation, retention, tax efficiency, succession, and governance appetite. If your sum leans toward long-term value and you can fund the repurchase obligation, the analysis often points to an ESOP as the optimal path for shared ownership and future growth. Structuring for resilience means blending approaches. ESOPs offer unmatched tax efficiency and drive future enterprise value, while traditional benefits provide immediate liquidity and predictable support. A combined strategy captures long-term wealth creation and short-term security for a robust compensation plan. Finally, the decision path. Start with a repurchase model, survey culture readiness, and meet ESOP counsel, then choose a path. Pilot a 30% ESOP block if it tests well, or maintain traditional benefits if not. The practical step is simple. Schedule the first small action this quarter to keep momentum moving forward.